Today, I'm going to tell you about 3 Peter Lynch style stocks to buy and hold forever. Peter Lynch is one of the best professional investors of our generation. He returned 29% over a period of like 13 or 15 years. He focused on staying invested, owning stocks that are simple and easy to understand, and looking for companies that have long-term earnings growth. All right, so first, let's go over Peter Lynch's strategy. When Peter Lynch invested, he tried to combine growth and value investing principles, and he wanted to own companies with strong growth but avoiding crazy valuations. That's something I'm personally trying to apply to my own investing style. He's got a couple famous quotes, right? He said, "Far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves." And this feels a little awkward right now. We are clearly in a correction, right? And the people that were bearish, that have been negative on the market this year, are clearly just running all over us optimists, right? But we have to think about how long have those people been bearish. If it's been anything more than 2 to 3 years, you would have actually been better off just buying stocks the whole time. And so that's lesson number 1, right? Long-term focus. And they quote, "Missing the 10 best days in any decade going back to 1930 had a significant impact on an investor's long-term performance." And it's impossible, in my opinion, for lonely little people like me and you to be able to time the market. The best thing we could do, in my opinion, is try to earn more money over time, save money, and then invest 15, 20, maybe even 30% aspirationally of our income every single year. If you can do that and you stick to it, you will probably be a millionaire in 10, 20, or 30 years. So Peter Lynch focused on what's called secular growth. And basically, for real returns, Lynch focused on defensive growth companies that would see their earnings rise despite market corrections. So trait number 1, we're looking for companies that can grow earnings over a long period of time. Seemingly boring companies with competitive advantages and steady growth were a prime target during recessions. These companies benefit from secular growth in their industry, which means demand for their goods and services is likely to remain robust regardless of the market cycle. And then he looks for what's called a valuation cushion. So the quote here, "I don't think people understand there's a 100% correlation with what happens to a company's earnings over several years and what happens to the stock. Focus on earnings growth was a cornerstone of his investment strategy. The strategy has been distilled into a price to earnings growth ratio. By adjusting a company's price to earnings for future growth, Lynch believed the downside risk could be mitigated." So that's what we're going to focus on. Long-term earnings growth, and then buying companies at a reasonable price. If you don't know me, I'm Austin. I'm building a $1 million portfolio right here on YouTube. A lot of these companies I own are probably not companies Peter Lynch may have owned because they are more speculative, one might say. So I'm not saying anybody should go out and follow me, but I want to be transparent. I have a $108,500 portfolio. We are up $5,000 today, so almost 5%. Over the last week, we're up $4,000, and all time, which I started this portfolio on February 15th, I've put in $118,000, and we're now right around $108,000, so we're down about $10,000. I track this portfolio, so if you want to get all my updates and see my portfolio either lose a ton of money or make a ton of money over the next 5, 10, 15 years, make sure you subscribe to the channel and like the video. It helps other people find it. Here's the portfolio from largest to smallest. You can take a screenshot, look at the positions, whatever, but do your own research. I'm not recommending these to you. This is just what I own. Talk to your own advisor. I'm not a financial advisor, blah, blah, blah. This is not advice. Let's talk about these 3 stocks, right? I think Peter Lynch would actually be buying these stocks hand over fist, and they're the types of stocks that you can buy and pretty much own for life, right? First up, we have Lowe's. What I want to see is companies that have outperformed over the last 20 years and the last 10 years, right? And so Lowe's, even though it's down a lot, is still up 12% per year over the last pretty much 20 years. And then over the last 10 years, it's up 21% per year, which crushes the S&P 500. Then if we look at the last 10 years, we could see the earnings growth, remember Peter Lynch talked about this, is 19%, meaning the price to earnings growth ratio would be right around 19, and the price to earnings ratio is currently at 14, meaning it is below a PEG, price to earnings growth, of 1. Exactly the type of stocks Peter Lynch was looking for. Now, if we take this out and it gets back up to its price to earnings growth of 1 rate, then you would get a 68% total return from now until January 25th, which is 25% annualized. That would be amazing returns. Stock number 2. I bet you've heard of Lowe's, and I bet you've heard of Deere, whether you live on a farm or not. Again, Deere over the last 21 years is up 17.5% per year, crushing the S&P 500. Then if we go to the last 11 years, it's up 18.37%, also crushing the S&P 500. And if we go to its chart, it's got 12% earnings growth, which puts it right around a PEG, price to earnings growth, of 15. So it's currently at a PE of 16.88, which is a little bit above that, but earnings is expected to continue to grow. And I don't know of another company that's going to be as important as Deere when we think about what the future looks like. And so even with its expensive price to earnings ratio, you're still looking at a positive annual return over the next few years. And it's hard to think of a company that's going to come and disrupt Deere. Finally, we've got Nike. If you haven't heard of Nike, I don't know who you are or where you live. You must be from outer space. If we look over the last 20 years, Nike's up 15% per year, crushing the S&P 500. Over the last 10 years, it's up 13.5% per year, slightly beating the S&P 500, but still beating the S&P 500. Now we jump over, it's got about 11% earnings growth. This is the one that is slightly overvalued or not as undervalued as the others. But if you look, Nike has rarely traded under a PE of 25. Really over the last 5+ years, and for the quality of brand that Nike is, the cash on the balance sheet, this I believe is a great opportunity to be considering owning Nike. And if you look at the average PE ratio it's traded at, it is below its average PE ratio of the last 13 years. And so if you price it out and it gets back up to its average PE through 2025, you're looking at about a 46% return for 15% annualized. Let me know if you own any of these stocks. What other stocks you think Peter Lynch would be buying right now? Let me know in the comments.